Hey guys, what's up? Welcome back to another video. In this video, I wanted to talk about Valero, and we can see that this company over the last 12 months is basically breaking even, whereas the rest of the market is currently up about 40%. So Valero is clearly underperforming the market at the moment. But I wanted to talk about this video because I know that Warren Buffett is currently really interested in Occidental Petroleum. So he is investing in the energy sector. And it looks like Valero might actually have an edge over OXY in a couple of different metrics. So it could present a good buying opportunity at the current share price. I wanted to not only look at their financial statements, but also, similar to as I do in other videos, calculate their intrinsic value per share because it looks like Valero might actually be trading below their estimated intrinsic value. So for starters, Valero is currently trading at around $130 per share, and analysts are giving it a price target of around $159 to $165 per share, which suggests a potential upside of around 20% from its current share price. More recently, Valero's revenue and earnings have declined in 2024 compared to the previous year due to lower demand for gasoline and jet fuel compared to the post-pandemic recovery period of 2022 and early 2023, which has impacted their ability to generate revenue. Valero is also valued attractively at a price-to-earnings ratio of about 7 times earnings, indicating that it could be undervalued relative to its earnings potential. As I said before, Warren Buffett has invested heavily into one of Valero's competitors, Occidental Petroleum, but Valero appears to have an edge over OXY in 2024 due to a few factors. Valero has a strong return on equity of 35% compared to Occidental's 20%, indicating that Valero is generating more profit relative to its shareholders' equity, making it more efficient in terms of generating returns for investors. Valero also has a higher and more stable dividend yield, around 3.14% compared to Occidental's 1.21%, which could be attractive for more income-focused investors. Both of these companies are operating in the energy sector, which is vulnerable to short-term price fluctuations in oil prices due to geopolitical events, and rising interest rates and inflation could impact Valero's operational costs. Inflation could end up driving up costs of raw materials and labor, potentially eating into profit margins if Valero is unable to pass these costs off to customers. But that being said, Valero's robust cash flow and strong cash position allows it to navigate periods of higher inflation better than its more leveraged competitors like Occidental Petroleum. So right here, we can see their financial statements for the first 3 quarters of 2024. And we can see that for the first quarter, they had revenue of about $31.7 billion, which was down from $36.4 billion. That's a decrease of about 13% year over year. And then if we scroll down and look at their net income, we can see they had net income of about $1.2 billion, down from $3 billion, which is a decrease of about 60% year over year for the first quarter of 2024. Also, if we go to page 7 here, we can see their cash flow statement for the first quarter. They had operating cash flow of about $1.8 billion, which is down from $3.1 billion year over year. But we can see in their financing activities here that they purchased common stock of about $1 billion, which is also down from $1.4 billion. And they paid out stock dividends of about $350 million, down from $370 million. So a bit of a slower quarter this year than last year, and that trend basically carried over to the second quarter and the third quarter, as we'll see right here. So for the second quarter, we can see they had revenue of about $34 billion, which basically stayed even from 2023 to 2024, but their expenses increased, and as a result, their net income was only about $880 million, down from $2 billion, which is a decrease of about 55% year over year. If we go to page 7 and look at their cash flow statement, or in this case, page 8, we can see for the first 6 months, they had operating cash flow of about $4.3 billion. So although still not as good as the post-pandemic recovery period, they're still posting really impressive operating cash flow. And then we can see for their financing activities, they purchased common stock of about $2 billion, and they paid dividends of about $700 million. So they've returned about $2.7 billion back to shareholders through stock repurchases and also through stock dividends or cash dividends, which is a pretty substantial portion of all of their operating cash flow, nearly almost all of it, more than 50% here. So that's obviously very good news for income-focused investors. Lastly, we can see right here for Q3, their income statement shows that their revenue declined from $38 billion to $32 billion, which is a decrease of about 14%. And then we can also see that for net income, their net income declined from about $2.6 billion to $360 million, which is a decrease of about 86% year over year. So a pretty massive decline in revenue and earnings, obviously year over year for the first 3 quarters for Valero. But that being said, their cash position is still strong. They're still adding to their retained earnings on their balance sheet. So hopefully they'll be able to bounce back in the future and get back to some higher revenue and earnings numbers that they were seeing in the post-pandemic recovery period. So now we can see this discounted cash flow model. I'm going to try to calculate the intrinsic value per share for Valero. Keep in mind, DCF models use a lot of assumptions. So it's important to note that based on these assumptions, your output may or may not be inaccurate. And you'll see based on this DCF model why I prefaced this analysis with that statement. But right here, we can see historic growth rate calculation, about 20% for their free cash flow from 5 years ago until today. That being said, there were some years where they posted negative free cash flow growth. So although on paper, their free cash flow grew 20% year over year from 3 billion to 8 billion, some years they posted negative free cash flows. So it's tough to say what their growth rate will actually be in the future because the energy sector is very cyclical and dependent on variables that are outside of a lot of energy sector or energy companies' control. For the weighted average cost of capital, I used this calculator right here. It came out to about 6%, as we can see up here. And then for their balance sheet, they currently have a net debt position of about $5 billion and about 300 million shares outstanding. Puts their intrinsic value per share at about $800 per share, which, as you can see from their stock price, means that Valero would be severely undervalued at the current share price. And you can see why I prefaced the analysis with this statement, because based on the previous cash flow growth for the last 5 years, if we're comparing that to the next 5 years, it looks like Valero is going to grow almost 1,000% from their current share price, which obviously I think is pretty optimistic. So I think it'd definitely be smarter to be more conservative. But that also coupled with the fact that they have a pretty low PE ratio might suggest that Valero is actually currently trading below their intrinsic value per share, although maybe not to the same extent that this DCF model predicted with this pretty steep intrinsic value estimate. And then we can also see right here, I did a competitor/industry analysis comparing Valero to Oxy and ExxonMobil. We can see that based on the financial ratios that Valero is doing worse than their two competitors here in terms of profit margins. But in terms of return on equity, Valero is doing a lot better than Occidental Petroleum and ExxonMobil at 35%. PE ratio is a lot lower than the two competitors. So if Valero is currently a little bit undervalued compared to their competitors, then if their PE ratio ends up rising to that of their competitors, and the stock price will obviously also improve. And then we can also see dividend yield is one of the highest, way higher than Oxy's, more than double. We can see at 3.14%. So for every $100 you invest into Valero, you're getting paid about $3.14 per year, which is definitely one of the higher dividend yields in the stock market. Then right here, I wanted to compare Valero to some of the other companies we've looked at on this channel. In terms of intrinsic value, Valero comes in third place, trading at an estimated 16% of their intrinsic value. We can see Oxy and ExxonMobil, two of its main competitors, coming in first and second place. But like I said earlier, the DCF model uses a lot of assumptions, so please use the DCF model or other valuation models with caution. Then right here, we can see their growth rate. Obviously, Valero didn't make it onto this table because their growth rate was only at 19%, which isn't good enough to get them onto this table. But for dividend yield, they were able to make it onto the table, fifth place with their 3.14% dividend yield. And you can see the other companies, mainly other oil companies, which is no surprise because those are mainly income-focused investments showing up on this list here. Then I wanted to look at profitability and revenue and earnings growth. We can see that for profitability, Valero doesn't make it on here. No surprise there. Their gross profit and net profit margin were both below 10%. So you can see the other companies that did make it onto that list. But in terms of revenue and earnings growth, Valero does make it onto the Q1 earnings growth table. Even though they actually had negative earnings growth, it was still good enough to get them onto the top 10 list compared to all the other companies we've looked at. And then so far, we haven't really looked at that many companies in Q2 and Q3 of 2024. So Valero still makes it onto the list despite the fact that they had really poor revenue and earnings growth. And before that, it looks like Valero was not good enough to make it onto any of the other tables that we've prepared here for revenue and earnings growth for the past quarters. So basically, they haven't really been outperforming the other companies in the stock market, regardless of industry. But you can see the other companies here that repeatedly show up on the list: Nvidia, Google, McDonald's, for example. And those companies are obviously showing better revenue and earnings growth than a lot of the other companies in the market at the moment. Then lastly, I wanted to look at stock performance over the last 5 years. Valero over the last 5 years is up 42%, which is very good for a company that pays a dividend yield as high as Valero, but obviously not as good as the other companies on this list, not good enough to get them onto the table. We can see Nvidia had the highest at 3,400%. So let me know in the comment section down below what you guys thought of Valero. Do you think that it's currently a better buy than Occidental Petroleum, Warren Buffett's prized energy sector investment at the moment? Let me know your thoughts in the comment section down below. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.